Silver price is about to crash to $30. The collapse nobody is discussing. Silver hit $32 an ounce, then $34, then nearly $36. And every analyst, every stacker, every precious metals channel told you the same thing. This is it. This is the moment silver breaks free. But here's what they didn't tell you. While retail investors were buying in at the top, something was quietly moving in the opposite direction. The institutions weren't following the narrative. The smart money was already walking out the door. And right now, the data is pointing to something that almost nobody in this space wants to say out loud. A price target that would erase years of gains overnight. What is that number? And more importantly, why is nobody discussing it? Stay right there. Welcome to Currency Insight, where we don't chase headlines, we decode them. Now listen, if this is your first time here, do me a favor. Hit that subscribe button. And I'm going to ask you the same way I'd ask my grandfather to finally get a smartphone. I know it takes one extra step. I know it feels unnecessary. But trust me, you'll thank yourself later. Just one click. That's all it takes to stay ahead of what the mainstream won't tell you. And while you're at it, drop a comment below right now. Tell us, where in the world are you watching from today? We've got viewers from New York to Karachi, from London to Lagos. Let's see where Currency Insight reaches today. All right, now let's get into it. It started with a feeling, not a financial report, not a boardroom decision, not a carefully calculated investment thesis, just a feeling. Somewhere around late 2023, a quiet whisper began moving through investment communities, social media groups, and late-night financial forums. The whisper said the same thing in 100 different ways. Silver is about to explode. And honestly, the argument made sense. The world was dealing with rising inflation. The United States national debt was climbing past numbers that felt almost fictional. Geopolitical tensions were heating up across the Middle East. The dollar, many argued, was losing its credibility as a store of value. And silver, raw, physical, tangible silver, felt like the answer to all of it. It felt safe. It felt real. It felt like something you could hold in your hands when everything else was falling apart. So people bought in. Not just a few people, millions of people. Retail investors, first-time buyers, young men and women who had watched their purchasing power shrink and decided that silver was their way out. They filled their safes, their drawers, their storage units. They called themselves stackers. They built communities. They shared price predictions with the confidence of seasoned analysts. And for a while, the market rewarded them. Silver climbed. It pushed toward $34 an ounce. Then it touched $35. At certain moments, it came dangerously close to $36. Every move upward was celebrated like a victory. Every dip was called a buying opportunity. The community grew stronger. The conviction grew louder. But here is where the story gets interesting. While retail investors were celebrating on the surface, something very different was happening underneath. Quietly, without announcement, without fanfare, the larger institutional players, the ones who manage billions of dollars, the ones who do not make emotional decisions, were beginning to reposition. They were not panicking. They never panic. But they were moving, and they were not moving towards silver. This is a pattern that serious market observers have seen before. It does not announce itself. It does not come with a press release. It shows up in the data, in futures positioning, in options flow, in the subtle way that large capital begins rotating out of one asset class and into another. The signals were there for anyone willing to look past the noise. But the noise was very, very loud, because the silver community had built something powerful, and that power made it almost impossible to hear the warning. Every YouTube channel was bullish. Every newsletter was bullish. Every comment section was filled with people reinforcing each other's belief that silver was heading to $50, $100, or beyond. The environment had become something that experts call an echo chamber, a closed loop where only one type of information is welcome and everything else is treated as an attack. Father Emmanuel Lemson, a trained financial analyst and chief investment officer at Lemelson Capital, had been watching this dynamic carefully. He is not a man who speaks carelessly. He is trained in the language of financial statements, balance sheets, and long-term capital allocation. And as early as January of this year, he began issuing a warning that very few people wanted to hear. He called silver and other precious metals essentially a bubble waiting to collapse. The response was predictable. He was dismissed. He was criticized. In communities built entirely around the belief that silver only goes up, a man who says this is going to fall is not treated as a voice of caution. He is treated as an enemy. But the market does not care about community feelings. The market moves on data, on yield differentials, on institutional behavior, on the cold mathematics of supply, demand, and macroeconomic positioning. And the data, even then, was not telling the story that millions of retail silver buyers had convinced themselves was true. It was telling a completely different story. Since that January warning, silver has fallen nearly 50% from its high. Not 10%, not 20%, nearly 50%. Gold, in the same period, dropped approximately 25%. These are not small corrections. These are not temporary dips. These are the kind of moves that erase years of gains in a matter of months. And yet, the conversation about why this happened and where silver is actually heading next remains almost completely absent from mainstream financial discussion. The question is not whether the warning signs existed. They did. The question is why almost nobody was willing to see them. And the answer to that question is far more uncomfortable than the price of silver itself. Numbers do not lie. People lie. Narratives lie. Communities built around hope and conviction lie. Not always intentionally, but consistently. They filter reality through the lens of what they want to be true, and they discard everything else. But numbers simply exist. And in early 2025, the numbers were telling a story so clear, so precise, so completely at odds with the silver community's collective belief system, that the only explanation for why millions of people missed it is that they were never truly looking. They were listening to each other, to channels that confirmed what they already believed, to voices that told them what they wanted to hear. But they were not looking at the data. So let us look at it now, together, carefully, without agenda. When the United States Treasury's 10-year yield sits at 4.5% and the 30-year crosses above 5%, something fundamental shifts in the investment landscape. These are not just numbers on a screen. They represent a choice, a real mathematical choice that every serious investor faces. Why would anyone hold a non-yielding asset like silver when the United States government is offering a guaranteed 5% return on a 30-year bond? The answer, historically, is fear. Investors flee to precious metals when they believe the system itself is breaking down, when they no longer trust governments, currencies, or financial institutions. Silver and gold become relevant when the alternative feels more dangerous than the metal sitting in a vault. But that fear trade has a condition. It requires the macro environment to actually deteriorate in a visible, undeniable way. It requires the dollar to weaken. It requires inflation to spiral beyond control. It requires the kind of systemic breakdown that makes a 5% treasury yield feel meaningless. And in 2025, that breakdown never came. The dollar held its ground. The Federal Reserve showed no urgency to cut rates. In fact, hopes for a rate cut at the next FOMC meeting quietly disappeared. The system, despite all its very real problems, did not collapse. And without that collapse, the emotional foundation of the silver bull case, the fear trade, had nothing to stand on. The second fracture came from a direction almost nobody expected: war. The conflict involving Iran, Israel, and American military involvement was supposed to be silver's moment. Every stacker, every precious metals analyst, every community built around the idea of geopolitical chaos driving safe haven demand, they all pointed to the Middle East and said, "This is it. This is the catalyst." They were wrong. Gold did not surge to $6,000 as certain prominent analysts had predicted. Silver did not break through its resistance levels and march toward $50. Instead, both metals began a quiet, steady, deeply uncomfortable decline. The war that was supposed to send precious metals through the roof did the opposite. It exposed the fundamental weakness hiding underneath the bullish narrative. Because here is what the data revealed in that moment. The market had already priced in the geopolitical fear. Investors who bought silver at $34 and $35 were not buying the future. They were paying the premium for a story that the market had already moved past. By the time the average retail investor felt confident enough to commit their savings, the institutional money had already extracted its gains and repositioned elsewhere. This is not a new phenomenon. It has a name. It is called the retail trap. and silver in 2025 executed it with almost textbook precision. The third fracture, and perhaps the most important one, was visible in the historical record for anyone willing to study it honestly. Silver has crashed before, significantly, painfully, in ways that left entire communities of believers holding assets worth half of what they paid, sometimes for years, sometimes for decades. In the early 1980s, silver reached nearly $50 an ounce, driven by speculative buying, geopolitical anxiety, and a collective belief that the dollar was finished. Then it collapsed. Violently. It fell below $10 and spent the better part of 2 decades recovering. The pattern in 2025 carries uncomfortable similarities. A rapid price escalation driven more by sentiment than fundamentals. Retail participation surging at precisely the wrong moment. Institutional players quietly exiting while the community celebrates. And now, a price target of $30 per ounce that is not a prediction pulled from thin air. It is supported by technical analysis, by historical reversion patterns, by the mathematics of a market that ran far ahead of its fundamental justification. $30. That number represents not just a price level, it represents the moment when the distance between the story people told themselves and the reality the market was building finally closes completely. The fracture was never sudden. It was accumulating, quietly, patiently, invisibly, while the noise grew louder and the believers grew more certain. And the most dangerous part of this entire story is not the collapse itself. It is the silence that surrounded it. A silence so deep, so deliberate, so structurally maintained, that it begins to look less like oversight and more like a decision. Silence in a market is never accidental. It is never the result of oversight. It is never simply a case of analysts missing the data or communities forgetting to ask the right questions. When an entire ecosystem of voices, channels, newsletters, podcasts, forums, dealers, influencers, all fall quiet on the same uncomfortable truth at the same time, that silence has architecture. Someone built it, someone benefits from it, and someone, somewhere at the bottom of the chain, pays for it. In the case of silver's collapse, that someone is the retail investor, the working-class saver, the young entrepreneur who put 3 months of savings into physical silver because 17 different YouTube channels told him it was the smartest decision he could make. The retired school teacher who converted a portion of her pension into silver coins because a newsletter she trusted said the dollar was finished. These people did not fail to do their research. They did their research inside a system that was designed, whether intentionally or not, to show them only one side of the story. And that is the real collapse nobody is discussing. To understand the silence, one must first understand the ecosystem. The precious metals media world is not structured like traditional financial journalism. It does not operate under the same pressures, the same editorial standards, or the same accountability frameworks that govern mainstream financial reporting. It is largely built around content creators, independent newsletters, and community-driven platforms, all of which share one critical characteristic. They are almost entirely funded by the very industry they cover. Bullion dealers sponsor YouTube channels. Precious metals companies advertise inside newsletters that review precious metals. Affiliate programs reward content creators every time a viewer clicks a link and purchases silver or gold. The financial incentive structure is not subtle. It is direct, transparent if one looks carefully, and deeply compromising to objectivity. This does not mean every voice in the precious metals space is dishonest. Many of them genuinely believe what they say. Many of them have held silver for years and remain personally committed to its long-term value. But belief and financial incentive, when pointed in the same direction, create something more powerful and more dangerous than simple bias. They create a closed system where contrary evidence cannot survive. When Father Emanuel Lemson issued his warning in January of this year, calling precious metals essentially a bubble, predicting significant downside, and advising investors to look toward productive, dividend-bearing assets instead, the response from the silver community was not engagement. It was not debate. It was not a serious counter-analysis examining his arguments point by point. It was rejection, immediate, emotional, and total. Because in an ecosystem built on a single narrative, the man who challenges that narrative is not treated as a thinker worth hearing. He is treated as a threat worth silencing. But there is a second layer to this silence, and it runs deeper than financial incentive. It runs through human psychology itself. Behavioral economists have studied for decades the phenomenon known as sunk cost bias. It describes the deeply human tendency to continue believing in something, a decision, an investment, an idea, simply because one has already committed to it. The more someone has invested, financially and emotionally, the harder it becomes to process information that suggests the investment was wrong. Silver stackers, by the very nature of their community, are among the most emotionally committed investors in any asset class. They do not simply hold silver, they believe in silver. They have built identities around it. They have convinced family members. They have argued with skeptics. They have posted their stacks online and received validation from thousands of people who share their conviction. To hear that silver is heading to $30 is not, for these investors, merely a financial update. It is an identity threat. And the mind, every human mind, responds to identity threats not with curiosity, but with defense. It dismisses the source. It questions the motive. It finds 17 reasons why the warning is wrong and holds on to them with everything it has. This is not weakness. This is not stupidity. This is simply what it means to be human inside a system that was never designed to protect the retail investor in the first place. It is a combination of financial incentive, structural conflict of interest, psychological defense, and community pressure, all working together, all pointing in the same direction, all keeping the same uncomfortable truth just out of reach of the people who need it most. And while that silence held, the data kept moving. The institutions kept repositioning. The price kept drifting lower. And somewhere in a storage unit, in a safe, in a drawer lined with coins purchased at $34 and $35 an ounce, millions of ordinary people are sitting with an asset that the market is no longer willing to pay what they paid for it. They were not foolish. They were simply never given the complete picture. And the question that remains, the question that Part 4 will now address directly, is what does a serious, clear-eyed investor actually do when the silence finally breaks? When the noise fades and the silence breaks, what remains is clarity. And clarity, real, uncomfortable, unfiltered clarity, is the most valuable thing a serious investor can possess in a market full of people still holding on to a story that the data has already moved past. The question is no longer what happened to silver. That story has been told. The fractures were visible. The silence was structural. The collapse was not an accident. It was the inevitable conclusion of a narrative that was never fully grounded in fundamental reality. The only question that matters now is a simple, forward-looking one. What does a serious investor actually do next? The answer begins not with a new asset to buy, but with a framework to think differently. Serious investors, the kind who build lasting wealth across decades rather than chasing short-term price movements, ask 3 questions before committing a single dollar to any asset class. First, does this asset produce something? This is the foundational question. A productive asset generates value over time. It pays a dividend. It returns capital to its owners. It grows its earnings. It has a financial statement that can be studied, challenged, and verified. Companies like General Mills, which has paid and consistently grown its dividend for over a century, answer this question with a track record that requires no faith, no narrative, and no community of believers to sustain it. The numbers speak entirely for themselves. Silver cannot answer this question. It sits. It waits. It depends entirely on the next buyer being willing to pay more than the last buyer paid. That is not investment. That is speculation dressed in the language of wisdom. Second, can this asset be measured? Serious capital allocation requires the ability to study what one owns. Balance sheets, income statements, cash flow reports, these are not bureaucratic documents. They are the language of business reality. They tell an investor whether a company is genuinely healthy or merely performing health. They reveal whether management is creating value or quietly destroying it. Warren Buffett has said, in various forms throughout his career, that he will not invest in what he cannot understand and measure. This is not timidity, this is discipline. And discipline, compounded across years, is what separates serious wealth builders from serious wealth losers. Third, does the current price make rational sense relative to what the asset actually produces? This is where Harley-Davidson becomes an interesting case study. A company with over a century of operating history, a globally recognized brand, and a shareholder yield approaching 16%, combining buybacks and dividends, trading at what serious analysts argue is a fraction of its true underlying value. Whether or not one agrees with that specific analysis, the framework itself is sound. Buy productive assets when the market undervalues them. Hold them long enough for the compounding to do its work. Collect the yield while waiting. This is not exciting. It was never meant to be exciting. Excitement in investing is almost always a warning sign. For the young entrepreneur watching this, the one carrying student debt, navigating an uncertain job market, trying to build something real in an economic environment that feels designed to work against them, the message of Part 4 is not discouraging. It is actually the most hopeful thing this entire documentary has offered, because the path to genuine financial independence has never required perfect timing. It has never required predicting the next collapse or catching the next rally. It has never required joining the right community or listening to the right influencer. It has only ever required one thing: discipline, applied consistently, across time. Live below your means. Learn the language of accounting. Study businesses with long histories of profitability. Ask the 3 questions before every decision. And let the compounding, slow, quiet, and extraordinarily powerful, do what it has always done for those patient enough to trust it. Silver at $30 is not the end of the world. But for those who bought at $35 believing the story without examining the data, it is an expensive lesson in the cost of silence. The real question was never about silver's price. It was always about whether serious investors were willing to see clearly, in a world specifically designed to keep them from doing exactly that.